Lyn Alden opens the discussion by detailing the concept of fiscal dominance, a monetary environment where government debt and deficits have reached such levels that central banks lose effective control over inflation and monetary policy. Unlike the prior decades of monetary dominance, where central banks, particularly the Federal Reserve, could manage inflation primarily by influencing bank lending, fiscal dominance occurs when government deficits and total debt overshadow private credit. This situation leads to persistent currency debasement and inflationary pressures that the Fed cannot easily counteract. Alden clarifies that in fiscal dominance, inflation is largely created by excessive government spending rather than by traditional bank lending expansion. The significance of fiscal dominance lies in its insidiousness. While it has a profound on-the-ground effect, hollowing out the middle class and inflating asset prices, it is not always readily apparent to average citizens until severe consequences emerge. Alden warns that people outside the circles owning significant assets suffer disproportionately in this environment, emphasizing the urgency of awareness and protective strategies. The middle class's decline is intricately linked to the rampant inflation and wealth concentration stemming from fiscal dominance. Inflation should not be misunderstood as a natural and unavoidable phenomenon. Rather, it is a deliberate consequence of fiscal policy and monetary expansion. Alden explains that inflation acts as a debasement of currency, reducing purchasing power and forcing individuals to own appreciating assets to preserve wealth. Those who cannot acquire assets, real estate, stocks, or commodities, effectively get left behind. This dynamic exacerbates income and wealth inequality, as parts of the middle class either ascend into wealth by possessing assets or slide into lower economic strata by being priced out of asset ownership. The housing market serves as a poignant example. Home ownership provides a path for some to remain middle class, but as affordability plummets due to soaring prices and interest rates, many are left excluded, accelerating middle class shrinkage. Historically, central banks have wielded interest rate tools to manage inflation and cool overheated economies by controlling bank lending. Alden contrasts this era with the current predicament where raising interest rates paradoxically worsens fiscal deficits. In the 1970s, when central banks raised rates to tame inflation, driven by excessive bank lending and supply shocks, the government's debt level was relatively low, making their interest burden manageable. Today, with the federal debt exceeding 100% of GDP, raising rates increases interest payments on government debt, expanding deficits and forcing further money creation, a vicious feedback loop. Thus, the central bank's usual brakes on inflation no longer work without triggering fiscal harm. This reversal is why Alden describes the current economic trajectory as a train without brakes, locked into a persistent inflationary spiral that current tools cannot effectively halt without real fiscal reform. Tom Bilyeu and Alden explore why decades after warnings about debt accumulation, the looming crisis remains unaddressed. In the late 1980s and early 1990s, public concern about national debt peaked, with figures like Ross Perot mobilizing political awareness. That era featured high interest rates and a rapidly growing but still manageable debt-to-GDP ratio. Strong demographic tailwinds and economic growth allowed for surpluses in the late 1990s. However, from that point forward, the world saw disinflationary forces from globalization, especially the opening of China, and declining interest rates that kept interest expenses manageable despite rising debt. Alden points out that recent shifts, including an end to the 40-year decline in interest rates and demographic changes moving baby boomers into entitlement drawdown, have removed those offsets. This altered backdrop creates unprecedented fiscal strain and explains the widening disconnect between political discourse then and now. Alden addresses the persistent U.S. trade deficit, a byproduct of the dollar's status as the global reserve currency, which structurally compels the U.S. to export dollars via trade imbalances. This arrangement results in significant economic imbalance, where manufacturing and middle-class jobs are hollowed out in regions like the Rust Belt, while wealth concentrates in cities tied to finance and technology sectors. The recycling of trade deficits back into U.S. asset markets by foreign capital inflates property and stock prices, benefiting asset holders disproportionately and making housing affordability worse for new entrants. While some politicians, including former President Trump, highlight the trade deficit as a problem, Alden stresses that the mechanisms proposed often fail to address the underlying systemic causes or the political realities of entrenched interests benefiting from the status quo. Regarding tariffs, Alden observes that they are essentially unilateral tax increases that the executive branch can impose without the usual political gridlock involving Congress. Tariffs generate hundreds of billions in revenue, but only modestly impact the enormous federal deficit. They are often portrayed as taxes paid by foreign exporters, but economic evidence suggests the burden largely falls on American consumers and businesses, especially affecting lower-income groups who spend a greater percentage of income on tariffed goods. Alden critiques tariffs as imprecise tools that, while offering some short-term fiscal relief and political theater, do not resolve deeper structural fiscal imbalances. She highlights how political polarization and resistance to taxing or cutting major entitlement programs create obstacles to meaningful fiscal reform. Tariffs alone cannot slow the train meaningfully without accompanying systemic adjustments. Central banking independence is a cornerstone of modern economic policy, but becomes strained under fiscal dominance. Alden describes how the Fed is restricted in its ability to fight inflation caused by large government deficits without worsening fiscal imbalances. Raising interest rates increases government interest expense, paradoxically generating more money creation and inflationary pressure. The Fed's mandate includes maintaining financial stability, and Alden asserts that in crisis situations, such as the Bank of England's 2022 gilt market crisis or the 2023 regional bank turbulence in the U.S., central banks prioritize market stability over strict inflation control. Therefore, the Fed cannot simply force fiscal discipline by hiking rates indefinitely, as this risks triggering bond market chaos and economic downturns that would destabilize the financial system. Alden and Bilyeu acknowledge the gravity of fiscal dominance's social implications. The entrenched entitlement system, combined with enormous debt and political unwillingness to cut benefits, indicates that financial soft defaults via inflation and purchasing power erosion are likely. This process disproportionately harms younger generations and the working class, deepening wealth inequality. The result is intensifying social and political polarization, with growing populism on both left and right, increasing violence, and internal fracturing reminiscent of historical precedents where extreme inequality fueled revolutionary upheaval. Alden warns that such dynamics are slow-burning but inevitable unless structural reforms occur, cautioning that pain will manifest as defaults on social promises, fiscal austerity, and social unrest. Despite the bleak outlook, Alden cautiously offers a framework for resolving the crisis. She underscores the need for the U.S. to skillfully back away from its excessive fiscal and trade imbalances by rebalancing entitlement systems, reducing healthcare costs, by far the largest fiscal driver, and rationalizing defense spending. There exists a possibility for gradual structured defaults, including means testing benefits and controlling unsustainable spending, to restore fiscal balance without catastrophic collapse. Alden points to examples like Japan, which, despite demographic challenges, manages significantly lower healthcare costs and slower entitlement growth. She emphasizes that unacknowledged and unresolved problems will exacerbate polarization and unrest, while gradual policy reforms could facilitate a transition toward more sustainable fiscal conditions and economic stability. Growth has prolonged the inevitability of fiscal reckoning, with decades of productivity gains from globalization and technological advancement masking rising deficits effects. Looking ahead, Alden suggests artificial intelligence could inject further productivity improvements, particularly in white-collar sectors, helping to offset some inflationary pressures and sustain standards of living. However, she tempers enthusiasm for AI by cautioning that real-world implementation, especially physical automation, is slower and more complex than popular narratives suggest. Limitations in bottlenecks, timeframes, and infrastructure mean AI is unlikely to serve as a panacea for fiscal problems in the near term, but can contribute to incremental growth and productivity improvements. Ultimately, innovation can delay but not substitute for fiscal discipline. Turning to personal investing, Alden advocates a three-pillar portfolio approach tailored for fiscal dominance conditions. Traditional balanced portfolios with bonds falter when inflation erodes fixed income returns. Instead, her strategy combines high-quality equities, hard money assets like gold and commodities, and cash equivalents for stability and liquidity management. She categorizes Bitcoin as a form of money and portable capital, uniquely solving a long-standing problem of fast settlement absent in fiat and traditional financial systems. Bitcoin offers a scarce, decentralized alternative to deteriorating fiat and gold assets. While volatility remains high, Alden predicts a gradual decline aligned with growing adoption and liquidity. She advises investors to hold meaningful but measured Bitcoin allocations consistent with their risk tolerance and to integrate it alongside other inflation-resistant assets. Finally, Alden addresses the dollar's future as the world's primary reserve currency. She argues that no alternative fiat currency currently possesses the size, liquidity, and trust to unseat the dollar outright. Instead, the future likely involves a gradual diffusion of reserve holdings into a multipolar structure involving gold, Bitcoin, and regional currencies like China's yuan. This transition may alleviate some U.S. structural imbalances by reducing reliance on large trade deficits and the associated capital recycling mechanisms. Alden emphasizes that a managed, skillful de-escalation of dollar hegemony could allow the U.S. economy to balance more sustainably, whereas attempts to rigidly maintain the status quo risk exacerbating fiscal and trade tensions.